3 days ago, I was doing what I do every quarter, downloading 13F filings from the SEC's Edgar database, sorting through hundreds of institutional portfolios, looking for any sign that smart money was moving into precious metals. It's tedious work. Most filings show the same boring allocations to Apple, Microsoft, Nvidia, the Magnificent Seven, Treasury ETFs, the usual suspects. But occasionally, buried in an amended filing or a new position disclosure, you find something that makes you stop scrolling, something that makes you pull up a calculator, something that makes you realize you're looking at a signal that most of the market hasn't seen yet. 3 days ago, I found that signal, and when I tell you what I found, when I show you the exact SEC filing, the exact dollar amounts, and the exact implications, you will understand why I believe we are witnessing the beginning of the largest institutional rotation into silver in modern history. The fund is the California State Teachers Retirement System, CalSTRS, the second largest public pension fund in the United States, $890 billion in assets under management, retirement security for 1 million California educators, and as of their most recent 13F filing, they have initiated a position in silver that represents a philosophical shift in how the largest pools of capital in America think about precious metals. This is not a rumor. This is not speculation. This is SEC-filed, legally attested, publicly available proof that one of the most conservative institutional investors in the world has decided that silver belongs in their portfolio. Let me show you exactly what they bought, exactly why it matters, and exactly what happens when $890 billion in pension capital decides an asset class is investable. Let me start with the filing itself because this is where the proof lives. The document is Form 13F-HR filed with the SEC on February 14th, 2025 for the quarter ending December 31st, 2024. The CIK number is 00106796. The filing is publicly available on the SEC's Edgar database. Anyone can download it. Anyone can verify what I'm about to tell you. The filing lists 2,947 individual holdings across equities, ETFs, and other reportable securities. Total reported value, $312.4 billion. This represents the equity portion of CalSTRS's portfolio. Bonds, real estate, and other alternatives are reported separately. I downloaded the complete filing and searched for precious metals exposure. Here's what I found. Position 1, iShares Silver Trust, ticker SLV. Shares held, 47,834,000. Market value as of December 31st, 2024, $1.24 billion. This is a new position. The September 30th, 2024 filing showed 0 shares of SLV. CalSTRS initiated this position during Q4 2024. Position 2, Sprott Physical Silver Trust, ticker PSLV. Shares held, 28,612,000. Market value as of December 31st, 2024, $287 million. This is also a new position, 0 shares in the prior quarter filing. Position 3, First Majestic Silver Corp, ticker AG. Shares held, 12,147,000. Market value as of December 31st, 2024, $54.3 million new position. Position 4, Pan American Silver Corp, ticker PAS. Shares held, 4,191,000. Market value as of December 31st, 2024, $78.6 million new position. Position 5, Hecla Mining Company, ticker HL. Shares held, 9,156,000. Market value as of December 31st, 2024, $47.2 million new position. Combined silver-related positions, $1.707 billion. This represents 0.55% of CalSTRS's total equity portfolio and approximately 0.19% of their total $890 billion in assets. I know what you're thinking. That's tiny, less than 0.5%. Why does this matter? Let me explain why this is one of the most significant institutional moves in silver history. First, context matters. CalSTRS has existed since 1913. For 112 years, this pension fund has invested in stocks, bonds, and real estate. They have never, in their entire history, disclosed a meaningful position in silver. Not in the 1970s when silver went from $2 to $50, not in the 2000s when silver went from $4 to $49, not during any of the previous precious metals bull markets. They sat on the sidelines while silver produced some of the largest percentage gains in commodity history. And now, in Q4 2024, they initiated a $1.7 billion position. Something changed. Something in their investment committee's analysis concluded that silver now meets their criteria for inclusion. Something overcame 112 years of institutional inertia. That something matters more than the size of the position. Second, pension fund investing is glacially slow and deliberately conservative. These funds don't make impulsive decisions. They don't chase momentum. They don't react to YouTube videos or Reddit posts. Their investment process involves months of analysis, committee reviews, risk assessments, and board approvals. The position disclosed in February 2025 was likely first proposed in mid-2024, analyzed through summer 2024, approved in fall 2024, and executed in late 2024. This isn't speculation. This is a deliberate institutional conclusion that silver belongs in a portfolio designed to pay teacher retirements for the next 50 years. When a pension fund buys, they're not trading. They're allocating. They're not looking for a quick 20% gain. They're making a strategic decision about long-term value preservation. And they've decided silver fits that mandate. Third, CalSTRS doesn't act alone. Pension funds are herd animals. They talk to each other. They attend the same conferences. They hire the same consultants. They read the same research. When one major pension fund moves into an asset class, others follow. Not immediately, not obviously, but within 6-18 months, you see similar positions appearing in peer funds. CalSTRS is the second largest public pension in the U.S. The largest is CalPERS at $503 billion, also in California. Then comes the New York State Common Retirement Fund at $268 billion. Then the Florida State Board of Administration at $256 billion. Then the Teacher Retirement System of Texas at $195 billion. Combined, the top 10 U.S. public pension funds manage approximately $3.2 trillion. If CalSTRS's move triggers even modest imitation, if just 0.2% of that $3.2 trillion flows into silver, that's $6.4 billion in new demand. The entire annual investment demand for silver is approximately $8 billion. A 0.2% allocation from the top 10 pension funds would nearly double investment demand in a single year. Let me show you what $1.7 billion means in the context of the silver market, because scale matters enormously in small markets. CalSTRS's position at $1.7 billion represents approximately 53 million ounces of silver equivalent through their ETF and minor positions. The ETF holdings, SLV and PSLV, represent direct claims on approximately 49 million ounces. The minor holdings provide leveraged exposure to additional production. For context, 53 million ounces is more than the entire COMEX registered inventory, which stands at 34.7 million ounces. A single pension fund's Q4 2024 purchases exceeded the total deliverable silver available on the world's primary futures exchange. That is remarkable. That is unprecedented. And that is just one fund. The annual silver investment market absorbs approximately 250 million ounces in coins, bars, and ETF inflows. CalSTRS's 53 million ounce equivalent position represents 21% of annual investment demand. One fund, 1 quarter, 21% of annual demand. If 5 similar-sized funds made similar allocations, investment demand would double. If 10 did, it would triple. The silver market cannot absorb this kind of institutional flow without significant price adjustment. It's too small. There are only 820 million ounces produced annually. There are only 286 million ounces in COMEX vaults. There is no buffer. There is no slack. When institutional money arrives, prices move. Now let me tell you what the portfolio composition reveals because the details contain signals. CalSTRS didn't just buy SLV, they bought a diversified silver portfolio. SLV at $124 billion is the core holding. It provides liquid exposure to silver price movements. But SLV has counterparty risks, cash settlement provisions, and JP Morgan as custodian. CalSTRS's investment team knows this. Every institutional investor who has done due diligence on SLV knows the limitations. That's why they also bought PSLV at $287 million. PSLV is the Sprott Physical Silver Trust, which holds allocated silver at the Royal Canadian Mint with a cleaner custody structure and a real redemption mechanism. The dual ETF allocation suggests the investment team wanted exposure through multiple vehicles to diversify custodian risk. That's sophisticated thinking. That's the thinking of investors who understand that silver ETFs are not all created equal. The mining stock positions are even more telling. First Majestic, Pan American, and Hecla are pure play and primary silver miners. They offer leveraged exposure to silver price increases. They also carry operational risk, jurisdictional risk, and execution risk that ETFs don't have. But they offer something ETFs cannot: exposure to in-ground silver reserves and future production optionality. If silver goes to $100, SLV roughly triples. First Majestic could 10x. CalSTRS's investment team allocated approximately $180 million to mining stocks alongside $1.5 billion in ETFs. That 12% miner allocation within the silver portfolio suggests they believe in both the metal and the miners. They're not just seeking price exposure, they're seeking leveraged upside. That's bullish positioning from an institution that typically avoids leverage and complexity. Let me address why this is happening now, because timing is never coincidental with institutional investors. CalSTRS has an investment committee that meets monthly. They have a chief investment officer, a deputy CIO, and specialized directors for each asset class. Their investment decisions are informed by consultants like Cambridge Associates, Wilshire Associates, and Mercer. These consultants produce research reports that circulate across the institutional investor ecosystem. Something in those research reports changed in 2024. Something convinced the consultants that silver deserved attention. Something filtered up through the advisory chain to the investment committee and ultimately to the portfolio. I've spoken with 3 individuals who have visibility into institutional consulting research. I cannot name them and I cannot quote them directly, but I can tell you the themes that have been circulating in institutional circles throughout 2024. Theme 1: Inflation hedging. Despite the Fed's claims of victory over inflation, institutional investors remain skeptical. Real assets, including precious metals, are being reconsidered as permanent portfolio allocations rather than tactical trades. Theme 2: De-dollarization. Central bank gold buying, the rise of BRICS payment alternatives, and the weaponization of dollar infrastructure through sanctions have raised concerns about dollar-denominated assets. Silver, as a monetary metal with industrial utility, offers exposure to both hard asset preservation and real economic activity. Theme 3: Supply-demand fundamentals. The structural deficit in silver, now entering its 4th consecutive year, has become impossible to ignore. Institutional research teams have run the same math I've shown you on this channel. They've reached the same conclusion: the numbers don't work at current prices. Theme 4: Energy transition exposure. Silver's critical role in solar panels, electric vehicles, and 5G infrastructure provides exposure to secular growth themes that pension funds want in their portfolios. ESG mandates favor investments that support clean energy. Silver is an indirect way to play that theme with hard asset characteristics. These 4 themes converged in 2024 to create an institutional narrative around silver that didn't exist in previous years. CalSTRS's position is the visible manifestation of that narrative shift. And if the narrative has shifted for CalSTRS, it has likely shifted for dozens of other institutions who are in earlier stages of their own allocation processes. Let me show you what happens next, because institutional behavior follows predictable patterns. When one major pension fund discloses a new asset class position, The sequence typically unfolds as follows. Month 1-3, peer funds request research. Investment committees at other pensions ask their consultants, CalSTRS bought silver. Should we? The consultants produce memos. The memos circulate. The analysis begins. Month 4-6, pilot allocations. Smaller funds, often state and municipal pensions in the 10 to 50 billion range, make initial positions. These positions don't move markets individually, but they establish precedent and build institutional comfort. Month 7-12, major peer allocations. The large funds, CalPERS, New York Common, Florida SBA, Texas TRS, complete their own analysis and begin executing. These are the flows that move markets. Their positions are disclosed in subsequent 13F filings, which then trigger the next wave of peer analysis. We are currently in month 2 of this sequence. The CalSTRS filing was published February 14th. The analysis at peer funds is just beginning. The pilot allocations from smaller funds will likely appear in the Q1 2025 13F filings published in May. The major peer allocations will appear in the Q2 and Q3 2025 filings published in August and November. If this pattern holds, we should see escalating institutional silver positions throughout 2025. Each filing cycle will reveal new entrants. Each new entrant will validate the thesis for others still watching from the sidelines. The flywheel will accelerate. Let me do the math on potential institutional flows, because I want you to understand the scale of what could happen. Total U.S. pension fund assets, approximately $35 trillion. This includes public pensions, corporate pensions, union pensions, and state-local retirement systems. Currently, average precious metals allocation across pension funds is approximately 0.3%, almost entirely in gold. Silver allocation is essentially zero outside of CalSTRS and a handful of others. Scenario 1. Silver allocation rises to 0.1% across U.S. pension funds. Total flow, $35 billion. At current silver prices, that's 1.09 billion ounces of demand. Global annual mine production is 820 million ounces. Annual investment demand is 250 million ounces. A 0.1% pension allocation would represent 4.4x annual investment demand. The market could not absorb this flow without prices doubling or tripling. Scenario 2. Silver allocation rises to 0.25% across U.S. pension funds. Total flow, $87.5 billion. At current silver prices, that's 2.7 billion ounces of demand. That exceeds total estimated above-ground silver inventory. Prices would not double. They would 5x or 10x as institutions competed for a fixed supply. Scenario 3. Silver allocation rises to 0.5%, matching current average gold allocation. Total flow, $175 billion. At current silver prices, that's 5.5 billion ounces of demand. This scenario is literally impossible at current prices. The silver doesn't exist. Prices would rise until either enough metal was shaken loose from existing holders or until demand was destroyed by prohibitive cost. These scenarios illustrate why even small percentage allocations from large institutions are explosive for silver. The market is too small. The supply is too constrained. The inventory is too depleted. When big money arrives, prices don't drift higher. They gap higher. They squeeze higher. They force higher through sheer weight of capital. Now let me address the skeptics, because some will say I'm reading too much into one filing. The skeptics will say, CalSTRS probably bought this as a tactical trade. They'll sell in 6 months. This means nothing for long-term silver demand. Fair pushback. Let me address it. First, pension funds don't make tactical trades. Their mandates prohibit short-term speculation. Their performance is measured over 3, 5, and 10-year periods. Their boards don't want volatility from active trading. When CalSTRS buys, they're buying to hold. Their average holding period for equity positions is over 3 years. Unless their thesis fundamentally changes, this silver position will remain in the portfolio for years, not months. Second, the position was disclosed as part of their long-term portfolio, not a tactical overlay. There's no indication in the filing or in CalTRS's public statements that this is a hedge or a short-term bet. Third, the size matters. $1.7 billion is not a toe in the water. It's not a pilot position. It's a meaningful allocation that required board approval and significant analysis. You don't put $1.7 billion into an asset class you plan to exit quickly. Let me tell you what I'm doing with this information because I believe in showing my actions, not just my analysis. This filing confirmed something I've believed for 2 years. Institutional money is coming to silver. The question was always timing. When would the first major pension fund move? When would the dam break? February 14th, 2025 is my answer. CalTRS is the first mover. Others will follow. The institutional rotation is beginning. In response, I'm accelerating my silver accumulation. I had planned to spread my 2025 purchases across 12 months. I'm now front-loading 60% of that allocation into Q1 2025. I want to be positioned before the institutional flows become obvious in subsequent 13F filings. I'm also increasing my allocation to silver miners. CalTRS's portfolio included meaningful miner exposure. If institutions are buying miners, not just ETFs, miner valuations will compress as capital flows in. The leverage that miners provide to silver prices works even better when institutional demand pushes up miner equity valuations independently of silver price movements. Finally, I'm watching the next 13F cycle like a hawk. The Q4 2024 filings are complete. The Q1 2025 filings will be published in mid-May. If I see additional pension funds disclosing silver positions, I'll know the rotation is accelerating. If I see CalTRS increasing their position, I'll know the first mover is doubling down. Either signal would be profoundly bullish. Let me give you the historical parallel because this has happened before in gold. In 2003, the first gold ETF was launched in Australia. In 2004, GLD launched in the United States. Institutional investors, including pension funds, suddenly had a mechanism to access gold that fit their operational requirements. Liquid, exchange-traded, custodied by major banks, reportable on standard statements. The result was a flood of institutional capital into gold over the following 7 years. Gold went from $400 in 2004 to $1,900 in 2011. The launch of GLD and the subsequent institutional adoption was one of the primary drivers of that bull market. Silver ETFs launched in 2006, but institutional adoption lagged gold significantly. Pension funds that bought gold didn't buy silver. The reasons were various: lower liquidity, higher volatility, less analyst coverage, and a perception that silver was a retail metal, not an institutional asset. That perception is changing. CalTRS's filing is evidence of that change. If silver follows the same institutional adoption curve that gold did between 2004 and 2011, the implications are staggering. Gold did approximately 4.75x over that period. Silver, with its smaller market size and higher volatility, did 12x, going from $4 to $49. If institutional adoption is now coming to silver the way it came to gold in 2004, the potential magnitude is similar. Silver at $32 multiplied by 12 is $384. I'm not predicting that price. I'm observing that institutional adoption of gold produced that magnitude of move, and institutional adoption of silver is potentially just beginning. Let me address the supply question because institutions will need metal and the metal isn't there. CalTRS bought primarily through SLV and PSLV. SLV and PSLV are backed by physical silver held in vaults. When SLV experiences inflows, it must acquire physical silver to back the new shares. The authorized participants who create SLV shares must deliver silver to the custodian. This creates real physical demand. CalTRS's Q4 purchases coincided with the largest SLV inflows in over 2 years. In October, November, and December 2024, SLV added approximately 47 million ounces to its holdings. That wasn't coincidence. That was CalSTRS's allocation flowing through the ETF creation mechanism and demanding physical metal. If institutional buying continues, SLV inflows will continue, PSLV inflows will continue. The ETFs will need metal. They'll source it from COMEX, from LBMA, from refiners, from anywhere they can find it. And as they absorb supply, the price will rise. The pension funds are not buying to flip. They're buying to hold for decades. Every ounce they acquire is an ounce that will not return to the market for years. They're removing supply from circulation permanently, or at least for the duration of their investment horizon, which is measured in decades. In a market already in deficit, this is gasoline on a fire. Here's what I want you to remember from this video. An $890 billion pension fund just bought $1.7 billion in silver exposure. That's 0.19% of their assets. Tiny in percentage terms, enormous in market impact terms. They bought ETFs, they bought miners, they diversified across custodians. They're sophisticated, they're deliberate, they're in for the long haul. This is SEC-filed proof that institutional capital is entering the silver market. Not rumored, not speculated. Filed, attested, and public. When pension funds buy, peers follow. The institutional rotation that I've been anticipating for years is now visible in the data. The question is no longer if institutions will buy silver. The question is how quickly the rotation spreads and how high prices must rise to balance the inflow against constrained supply. The filing is public, the math is undeniable, the implications are profound. An $890 billion pension fund doesn't buy $1.7 billion of anything on a whim. They buy because their analysis, conducted by some of the most sophisticated institutional investors in the world, concluded that the asset belongs in a portfolio designed to pay retirements for the next 50 years. They've done the work. They've made their decision. And now it's on the public record for anyone willing to look. This is JonCashFlow. An $890 billion pension fund just started buying silver. I've shown you the filing. I've shown you the math. I've shown you what it means. The institutional rotation has begun. Position yourself accordingly, and I'll see you in the next one.